Oh, thank you so much for joining us. I am here with the one and only Rob Chrisman of the Chrisman Commentary. And I had the opportunity to meet Rob in person actually at a camp event. And I just love how real you were in your answers, Rob. And we're all looking, like you said, for the unicorns and rainbows, but you keep it straight. And I thought it's just so important right now with all of the information about interest rates and the lawsuit that we just try to get as much positivity out there for people, for loan officers, for real estate agents. And so thank you so much. I know you're on a tight schedule, but if you wanted to quickly introduce yourself and we can get going in some of the important questions we're going to go over.
Sure. I'm Rob Chrisman, and I guess I've become known as just this guy who sends this commentary out at 5:30 a.m. every morning. But the longer version is that my background is in capital markets and hedging pipelines and watching the economy and interest rates and the Federal Reserve and so on and so forth. So the thing about the economy and interest rates, I think, to keep in mind, kind of the overarching issue isn't so much, uh, kind of a day by day thing. It's more the trend, and it's important to keep for people to keep in perspective. In general, we have a mortgage slant,
Mhm.
meaning that we have uh, we look at things through how does it impact mortgage rates? How does it impact home sales? How does whatever news come out impact us, which is understandable.
Yeah.
But there are other parts of the economy, and it's important to remember that there are other parts of the economy, and you can torture the numbers, as they say, anything that comes out, whether it's the consumer price index or whether it's the producer price index or new home sales, whatever it is, the thing to keep in mind is that news impacts parts of the economy in different ways.
Mhm.
So in general, we're sitting here in an environment where rates are certainly higher than where they were 4 years ago, right? During
Yeah.
2020 and 2021. Rates are higher. Nobody wants another pandemic, or nobody wants another disaster
Mhm.
to push rates back down into the twos or threes. It would be nice, but it's probably not going to happen. Nor is it likely that there's any news out there that are really push rates up much higher than where they are now. So
Okay.
that's kind of what we're looking at, is kind of this range bound interest rate environment. And in general, the Federal Reserve's not only looking at housing and borrowers and mortgage rates and so on, but it's also looking at different segments of the economy. And for the most part, in general, the economy is doing okay. It's not going gangbusters and it's not in the doldrums. It's just kind of doing okay.
And wasn't
When
that the
I
conversation that Powell recently had was like, hey, the economy is doing okay, right? So we don't see the need to lower rates. People are still spending and but that was the last kind of announcement that was made, right?
Exactly, the retail sales number, the U.S. consumer is alive and well and spending, and people are gearing up to go to Disneyland or Disney World or do their summer vacations or whatever. And airport parking lots are full and restaurants are bustling, and you drive down the freeway and there's kind of this economic hum that's out there. And the despite interest rates being higher than where they were 3 or 4 years ago. So the the focus has shifted to your slide here. The focus has shifted to what's going on with inflation, because it's easy to point to the Federal Reserve and say, oh, they want to control inflation. They want inflation back to 2%. And then the question is, well, how do they pick 2%? Or how do they pick
Right.
3%? Or how do they pick this magic level? And we could talk about that for an hour or two, but needless to say, they kind of have this target in mind of an inflation rate closer to 2% than where it is now. And so one of the things that the Federal Reserve can do, obviously, is push the interest rates that they set higher. And when interest rates go up, it tends to slow economic activity down because people are less inclined to borrow, less inclined to go out and buy a home, less inclined to go get a car loan, whatever. And if you're a manufacturer, less inclined to go build that manufacturing plant in Texas because you have to borrow the money and interest rates are so at a certain level that it doesn't make any sense. But here we are at this higher interest rate environment, and the economy has not really slowed down. People
Right.
are continuing to spend. People are continuing to buy homes if they can find the homes to buy. And so as the year has gone on, as 2024 has gone on, it's hard to believe we're
I
already
can't
halfway
believe.
through
Yeah.
April. Um, the the experts who last year and the year before were expecting a recession, expecting lower interest rates, forecasting this, forecasting that, and forecasting Federal Reserve cuts, it's not happening.
Yeah.
And the Federal Reserve has made it clear that they are, quote, data dependent, that they will continue to look at the data coming in terms of inflation, in terms of new home sales, in terms of consumer spending, in terms of unemployment, and continue to look at data. But for right now, they are they're all the federal government, district presidents are coming out saying, rates are okay where they are. And so if you were to base your business model on hope, on, gee, I hope rates come down because I could really use some more loans, that's not really a great place to be right now in terms of, you know, basing your career and your
Yeah.
and your business on interest rates. Yeah, interest rates. The good news, if there's any good news, the interest rates impact everybody the same way, of course. All the interest rates are higher for everybody. The question is, though, what I'm seeing companies do isn't so much, sitting there wringing their hands and saying, oh boy, we could really use rates in the fives or fours, but they're saying, okay, how can we help every precious borrower that we can?
Yeah.
How can we help every real estate partner, realtor partner, real estate agent partner that we have? What kind of down payment assistance programs do we have to offer? What kind of adjustable rate mortgage programs do we have to offer? What kind of high LTV programs can we offer so that when one of their clients does find a home that they can buy, that they have the Fannie Mae or Freddie Mac or non-QM or FHA or VA product that they can help that borrower with. So it's not, like I say, the successful loan officers are out there saying, all right, it is what it is. And the successful lenders are saying rates are what they are. And the environment in terms of the economy is what it is. But how can we help these borrowers finance their purchase?
Yeah. And when you jump off the call today, that's what I'm going to wrap up with is, the cost of waiting for people and doing a rent versus buy analysis and using the buy down options that we have available to help people get a lower interest rate now. And I read your commentary this morning and it was talking about the Stratmore report of borrower satisfaction, right? And people think that we do such a great job for our borrowers and we're getting all these reviews and it's great. But at the end of the day, are people really referring us, right? Are they really going out there and talking to their friends and their coworkers? And right now, I feel like for loan officers that have been in it for a while, like myself, that's the way to go, right? I mean, we were doing the social media and running ads and all this marketing and advertising and relying on realtors, but it's really going back to the families that we've helped and that we've stood out to and done an amazing job with and just saying to them, hey, listen, I'm still in this, right? And anybody that you come across that's looking to buy or refinance, please think of me if you had a great experience, which I hope you did. And are you seeing that around the market? That's kind of the buzz that I'm
It's,
hearing right now.
I'm a lowly capital markets guy, and I think that I certainly have an appreciation for how hard it is to be a good originator in this environment. 3 or 4 years ago, it was pretty easy. Loans were falling out of the sky. Interest rates were low. The
Mhm.
phone was ringing off the hook. Now you actually have to ask for business. You have to call up a previous borrower and say, hey, Samantha, hey, it's been, 2 or 3 years or 3 or 4 years. Just want to touch base. We had a good experience. Um, let me know if you hear of anybody else who might need help with financing. And I just want to check up on you and your family and see how things are going. And let me know if you need anything because you know, a lot of people are running up credit card debt, for example, and they're paying 25 or 30% interest rates on that credit card
Right.
debt. So even though they may have a 3% 30-year fixed rate loan, if they have 50 grand in 30% credit card debt,
Mhm.
gee, that's a discussion that you can have. I'm not saying you have to, that's the only reason, but maybe there's some other bill that they want to buy a Sprinter
Yeah.
or well, whatever it is. There are reasons to have the conversation, but it's a matter of picking up the phone, and it's easy for me, my capital markets background, to say, oh yeah, instead of making 5 outgoing calls a day, make 10 outgoing phone calls a day, and everything will be peachy. Well, everything won't be peachy. And it's easy for me to say make more calls,
Yeah.
but it's good to have a reason to make those calls. And even if you just leave a message to let them know you're still alive, it's still important because it's much easier to keep a client or to keep that acquaintance, that relationship going than make a new relationship. And
True.
so you already have a warm introduction with somebody you've already worked with, and hopefully they had a good experience and building on that. So
True.
it's a very tough environment.
All right, we have 3 minutes. And so I'm gonna have you sum up the NAR settlement in 3 minutes. No, I'm just kidding. So I saw recently the frequently asked questions that came out by CAR, and I posted that for my real estate agents. And there's so many questions out there from a loan officer's perspective and a buyer's agent perspective. There's so much confusion that's going on out there, right? The buyer can pay it, the seller can still pay it. I most recently read that you can't even go see a house now unless your representation, your agent, um, comes up with what their compensation is going to be, how much and how it's going to be paid before even going into a home. So people are asking what's going to go on with open houses or just, again, I know we're not going to hold you liable to this, but what's kind of like what should we expect? I mean, as originators or as buyers agents, any insight in that?
Well, yeah, there's a lot going on. Uh, Frankly, and I know for the people in your group, Fannie Mae and Freddie Mac just presented policies yesterday or the day before, and I had those in my commentary, Tracy. So if
Yeah.
you want to look at those
Okay.
and distribute those, I think those are worthwhile. The fact of the matter is, there's still a lot of confusion out there. The proposed settlement has not been ratified yet. And so there is this nebulous nature of things. Different real estate companies are coming out with different policies and different procedures. The overarching concern is that nobody wants to hurt the first time home buyer. I mean, you and your loan officers know better than anyone. Sometimes it takes years and years and years for family to save up a down payment. And then, oh, great, you've got a down payment. Now you're going to have to pony up another 3% because you have to pay for uh, your real estate agent's
Right.
commission. Well, nobody wants that outright. And so the question is, what is the minimum amount of damage that we can cause? Because first time home buyers, especially, they need somebody in their corner.
They do.
And the seller's real estate agent is not necessarily in their corner. And so they need that help. And
Yeah.
so the overarching concern that I've heard as companies move forward is how do we how do we minimize the impact on buyers and at the same time remind them that you know uh, things are negotiable, commissions are negotiable,
Yeah.
we'll figure it out. But I've seen, if you were to name 6 top real estate companies out there, it's like they've got 6 different policies going on.